Hello, everybody. It is 7:01. I'm just going to give an extra 2 or 3 minutes just to make sure everybody is in. In the meantime, let me share my screen for a second. And then in the meantime, I request that you go onto Moodle, go to our section 13. So let me go on to section. No, we're section 20. This is the right section. Scroll down to week 2. And you will see week 2 items. So click on that. You'll see unit 3 notes and week 2 lecture lesson 1. So please download these 2 items while we wait for everyone to arrive. Thank you very much. And yeah, we got 14, 15. Okay, we got a good amount of people in here. Just give me another 2 minutes just to make sure everybody's here. Makes for less disruptions in the future. Again, if you just joined, please go on to My UC West. Go on to week 2. So in there, at the top of week 2, you'll see a folder called week 2 items. Click on that, download the content, which is a PowerPoint, and the unit 3 notes. And I will pull it up on my end. So here's week 2, lesson 1, and the unit 3 notes. We have 15 people. We're supposed to have closer to 30, but I will get started. And thank you for being on time and being present. Yes, so without further ado, we shall kick everything off. So accounting, congratulations, you survived week 1. You have a little intro to accounting, so we're getting things started. Just to recap what happened last week, we went through the users of the financial statements. So we went through, so users of the financial statements include, sorry, this keeps popping up. Users of the financial statements include your managers who are using it to analyze the business, your investors, your potential creditors and lenders, some curious individuals that may just be watching or looking for whichever purpose it may be. And then you have the government that looks at it and oversight bodies that will look at your financial statements. So those were the users, and they were looking at different things within your financial statements. The structure of doing business, we know that there's 3 structures in Canada. There's the proprietorship, partnership, and corporation. We learned our 3 important accounting formulas, which includes assets equals liabilities plus equity. We learned that revenue and minus expenses gives you your net income. We learned that your closing retained earnings is your opening plus your net income minus your dividends. And those were the 3 accounting formulas that are going to come in handy throughout our course. We learned that there's 4 types of statements. So we have your income statement, balance sheet, cash flow, and statement of retained earnings. And we learned that there was a relationship between them. So your income statement flowed to your statement of retained earnings, your ending retained earnings flowed to your balance sheet, and what else was there? Oh, and the cash flows from your balance sheet flows to your statement of cash flows. So those are the relationships that there are. The kinds of accounting, we learned that there's 2 kinds of accounting, financial accounting and cost accounting. So financial accounting is external, it's highly regulated, we want to be able to compare across the board, and it's mandatory. Cost accounting or managerial accounting is optional. It's whatever analysis that the company needs to run to make business decisions. It's more informal, it's not as regulated, it can be however you see fit to do your calculations. So those are the 2 types of accounting. We learned how to take a look on CDAR and to obtain financial information. We'll be doing a little bit more of this today after our quiz. And we independently learned the fundamentals of ratio analysis. So we learned that there are 3 ratios. We learned there aren't just 3 ratios, but we learned 3 ratios. So we learned that there is your current ratio, which is current assets divided by current liabilities. We learned your debt to asset ratio, which is debt over assets, like the name entails. And then we learned your earnings per share, which is a profitability ratio, which is your net income divided by the average number of shares outstanding. There's a couple other complicated parts of that formula, but for simplicity, that's the overview of it. And then we learned about the concept of free cash flows. So you have free cash flows at the end of the day. What do you do with it? Do you reinvest it? Do you pay out dividends? Do you pay down your debt? What decisions do you make with that free cash flow that you have at the end of the day? So that was all from last week. I'll open the floor now if there's any questions about it, anything that you ran into issues with, anything that you want a little bit more clarification on. You've had some time to have everything settle in and also settle into the semester, so I open the floor to any of your questions. and I'll take a look. Feel free to unmute yourself or raise a hand. I'm happy both ways. Any issues going through this stuff? Any complications? Still feeling excited? Maybe feeling a little bit easier? Not as nerve-wracking? Any questions? We're good. We're accounting experts. We've tackled the foundation and we got it down. Okay, so we'll move on then. So just to recap, so I found this picture in your textbook, and I thought it was kind of a neat way of visualizing things and another way to look at things. So if this helps you, by all means, if it confuses you more, just close your eyes for the next 30 seconds and don't even look at it if you justified it to yourself in a different way. But this top line is your balance sheet. So assets equals liability plus stockholders' equity. So this formula we've seen. And then stockholders' equity breaks out into two pieces. So I just wanted to make sure that I make this clear, because equity is made up of your common shares, so your common stock, and your retained earnings. We saw this quickly on some balance sheets, but I didn't go into too much detail. So your common stock is the portion of your company that you're giving away. You give away a portion of your company for money to come in the door. So instead of going and raising capital by issuing debt, you are going through and issuing common stock. And then your retained earnings are just kind of accumulation of your profits over the years. So your retained earnings is broken down into revenues and expenses, and this is your net income minus dividends. And we've seen this formula before. So the only thing that this part is missing is it doesn't have your opening or ending. So your ending retained earnings would be your opening retained earnings plus revenue minus expenses minus dividends for the year. So just another way to look at things. So yeah, so that was week 1. So now we're in the fantastic land of week 2. So just to set things up, I just want to say that these learning objectives, so in case you're ever wondering where these learning objectives are coming from, they come from your syllabus. So if we go back to Accounting 621 and we take a look at this syllabus that was posted in week 0. So if you're ever wondering what's coming up, what the learning objectives are, what you're responsible for. So all of this box right here is the exact same box as this first slide on my PowerPoint. So I always try to tell you what the learning objectives are going to be. I'm not trying to surprise you. I'm not trying to trick you. I want you to know exactly what's expected of you to learn during this week, and then I'll go through one by one and explain what these items are. The second box tells you what chapters. So this week we are going to be doing chapter 3 on your own, and then chapter 5 we're going to go through together today. And then what kind of activities we're going to do. So this tells you what you're responsible for, how we're going to go through and learn the material, the essential skills, so what skills are you going to be required to have to get through the material, and assignments if there's anything due. So again, every class will have a quiz, which is worth 5%. And this first class, the Tuesday class, will be us going through me kind of lecturing, walking you through the material. And then the Thursday class is always kind of an independent working session where it'll be more hands-on. I'll give you examples, I'll give you a comprehensive problem to walk through, and then we'll kind of work through things together. But it's a little bit more independent, and then you'll have a bit of notes and items to review on your own. So that's the format. And if you're ever wondering where I get these learning objectives from, they come straight from the syllabus. So yeah, everybody's in here. Okay, so our learning objectives for week 2. So if you came on time, then I just asked you to go really quickly to my UC West on Moodle and download the week 2 sections. So you're going to download and read the notes for unit 3, and then this will cover off the learning objectives 1 and 2. So these blue learning objectives will be covered off by you going through and reading these unit 3 notes. So they've been uploaded, and you're responsible to independently kind of go through and understand this. I am open to questions next class, so we can go through anything that doesn't make sense in here. I try to keep these notes as like brief as possible. I don't want to give you like pages and pages and pages of text. So this is an overview. If you're looking for more information, then it's a good chance for you to research, or it's a good chance to communicate to me that you would like more items provided to you, and I'm more than happy to do that. But for the sake of your own kind of understanding, and I don't want to overwhelm and throw way too much stuff at you, I try to keep these pretty lean and as an overview. But if any of these concepts don't make sense, then I'm more than happy to go through them in more detail. So this is on you to read through, and these are the 2 learning objectives that you're working towards. So this is kind of like what you should have in the back of your mind as you're going through and reading those notes. And then today we're going to go through defining fraud and the principle of internal controls. Between here, we're going to have a little quiz, as we always do, and then we're going to go through and talk about a bank account and how it's a control feature. And then I'm going to teach you the theory behind a bank reconciliation. I'm just going to throw you kind of in the deep end with a theory, and then on Thursday, we'll go through and actually prepare a bank reconciliation together, so you'll have more of an idea of what it looks like and how it's going to happen. So don't worry if it doesn't all absolutely make sense today. It's going to come up again, and we're going to kind of solidify your understanding by doing a walkthrough of it. So that's what today's class is going to look like. So again, also these PowerPoints are now posted online, and if you look at if I go to one of my slides that has a lot of content, if you pull up this bottom thing, there's also some notes that I add at the bottom. So if you don't pick up everything I'm saying in class, or if I don't do a good job of explaining something, or it doesn't make sense to you, then you're more than welcome to come back and kind of look at the notes at the bottom of these PowerPoint slides to make sure that they're making sense to you. So that is also available. Sorry, I hear a murmur. Is there a question? Is there something I can help with? Everybody okay? Am I talking too fast? Again, please remind me if I am talking too fast. I had someone literally type out in the chat a couple days ago and say, please slow down. So I'm more than happy to. You just sometimes have to give me another reminder. So, okay. So we're going to go back to our... Yes, we were here. So we're first going to go through define fraud, our learning objective of defining fraud and the principles of internal control. So we'll kick it off with a discussion. You guys have been quiet so far, but I don't want you to stay quiet. I want you to help me answer these 3 questions. So the first question is, what is the definition of fraud? The second is, what is an example of fraud? And the third is, how does fraud happen? Now, if you go ahead in the slides, you can kind of cheat, but I don't want you to. I want you to just tell me off the top of your head, what do you think fraud is? So I'll open it up to you guys.
Illegal activity.
Illegal activity. Okay, yes. So do you want to elaborate on that? So what's an example of illegal activity that would be fraudulent?
Like money laundering.
Okay, yeah, money laundering would be a fraudulent activity. Good, perfect. Somebody has an interviewer. You're up next.
Ma'am, cheating someone with money for money, like Ponzi schemes, money laundering.
Yeah, money laundering, yeah, is a form of fraud, definitely, for sure.
Ponzi schemes.
Pardon me?
Ponzi schemes. P-O-N-Z-I.
P-O-N-Z-A? Bonza?
Ponzi.
Oh, Ponzi. Oh, yes, like a Ponzi scheme. Yes. So you're kind of bringing in a lot of people into this scheme that you know is fraudulent, but you're bringing them in and trying to get them to make you money when, yes. So a Ponzi scheme is fraudulent. You're tricking people to become your workers and then not really compensating them for all their hard work.
Insider trading.
Good. Pardon me?
Insider trading.
Insider trading, yeah. Insider trading is another example where you're using information that you have based on your position to benefit. So to profit for yourself, but not for the company. So yeah, insider trading is another example of fraudulent activities. Thank you, interviewer. That was a lot of good examples. Ponzi schemes, money laundering, like Lynette said, and using insider information for your own benefit. So Paula, what about you? What do you think?
I would say any type of illegal activity that somebody would engage just to take advantage or something. In the case of the companies, for instance, what we were reviewing is when you alter some of the numbers, for instance, for you to look like a solid company when it's not the case. And usually that happens when people go around. We say, go around, not follow the process, hide part of the process, alter part of the process, but it's always to take advantage of something, even that can be personal or related to a company, I would say.
Yeah, so it's a situation where your loss is your win is somebody else's loss. So you're doing something that you know is not necessarily right, and you're benefiting. But not you, Paula. I'm sure that you're very ethical and you're not fraudulent. But the person that's perpetuating the fraud is benefiting from it, and other people are it's to other people's demise. Yeah, that's a really good way to put it. Thank you, Paula. Gaurav, you have your hand up?
Yeah, I would like to add a point that is material misstatement in the financial statements because we can display some wrong facts in our financial statements to gain maybe loans from the banking sector so that we show them we are earning great deal of profits or revenues, but we are not, and hiding or showing fraudulent expenses so that we can reduce our revenues on the other side to not pay taxes. That could be fraudulent activities.
Yeah, perfect. So there's different incentives. So you might want to save, you might not want to pay as steep taxes as you might have to. So you might want to show higher expenses and lower revenue to have a leaner net profit line so that when you are evading paying taxes. And then on the other side of that, you're absolutely right. You might have an incentive to increase your revenues and decrease your expenses to show higher profits so that so you look more attractive to a bank or a lender. So yeah, it's taking steps, like consciously taking steps to change numbers on your financial statements to be able to meet some sort of criteria. Another one, Gaurav, that you kind of mentioned is bonuses. Like if management has bonuses based on net income or based on certain ratios, then they're going to be looking to kind of boost up and bring down certain numbers just to meet those thresholds so they can benefit and have their own bonuses paid out. So that's also something where fraud can occur. Shalini, what do you think?
Yeah. Hello, Professor.
Hello.
Okay. I feel that all the unlawful activities are referred to as fraudulent. So, any activity which is not legal, for instance, not filing tax returns. So, this includes in this particular case.
Yeah, definitely. So we are legally required to file tax returns, and not doing so is illegal. And then if you're not filing your tax returns, you're also not paying your taxes, and that can be considered fraudulent. So yeah, and it's for the benefit of the company at the demise of the government and the country as a whole because they don't get access to those public goods. Great. Thank you, Shalani. Behzad, what do you have to add?
Hello.
Hi.
I think fraud could be happened in different situation, but specifically in accounting, some accountants make a wrong balance sheet to do some fraud. I myself, I had experience in this situation
Wow.
that we have a accountant that do the same, and when we want to pay tax, we understand what happened.
Oh, so there was a different set of books for tax purposes and then a different set of books for day-to-day operations. How did the accountant
Yeah,
manage?
when we want to pay the tax, and the government say you have a different income,
Oh,
and
okay.
in that situation, we understand the accountant made it wrong.
Oh, interesting. And it wasn't for their own benefit then, it was for the company's benefit. So the accountant didn't do it for themselves, they did it for the company to
Yeah,
pay.
for themselves. Because some of incomes go directly in their own accounts. In this case, he could do that.
Oh, wow. That's quite the scheme.
Yeah.
And this is why we're learning about this, because we hope that people act ethically. We hope that there isn't fraud happening and that people are choosing to do the right thing. But unfortunately, it's not always the case.
I was worked there as a manager, and I think the reason that knowing accounting is important for a manager. One of
Yeah.
them is that.
Yeah, exactly. Because you need to know what's happening under your own roof. You need to be able
Yeah.
to catch stuff like this. So definitely. Thanks for sharing your
Thank you.
experience. That's some juicy details.
Thank you.
Pushpalata, what are your
Again, fraud is about a misrepresentation of a user. If I'm trying to fake my identity document and then creating an account, that again becomes a fraudulent transaction because you're producing some other ID, what you're not, and maybe that ID doesn't even exist or it's somebody else's. So that is also a fraudulent action.
Great. Thank you, Pushpalata. Sorry, I always have a hard time with your name. Pushpalata.
Pushpa, yeah, that's
Pushpa.
fine.
Okay, I will just say Pushpa. Perfect. Thank you, Pushpa.
Thank you.
Prashan, you're up next. Anything to add?
I think misappropriation.
Oh, sorry, you're so faint. You gotta yell into that microphone.
Misappropriation of company or the public resources can be
Yes.
considered as a fraud.
Yeah, so any misuse, let me know if I heard you correctly, but any sort of misuse of public goods or any misuse of company materials. So yeah, so even, and we got into this whole ethical discussion in one of my courses of, if you steal a pen, so if you just steal like a pen from your company, should you be fired for it? And it was just, and it's like, oh well, it's a pen, it's just something that's laying around, it's not of high value. But then it became this whole ethical discussion of, if you're willing to steal a pen from your company, what else will you steal from your company? So then we had this like 2-hour long ethical discussion about stealing a pen from a company. So yeah, so taking public goods from your company, or maybe misusing public goods, is also a method of fraud. Definitely. Thank you for that, Prashant. Harkamal, and then Sonia, and then we'll get on with our slides.
Hello, ma'am. I want to share a fake promise is also a part of fraud. Like in India, there is a company called who made a fake promise to the public that they will be double up their money in the 5 years. But after the 5 years, they did not return a penny of money to them, and and they left out their company. So that's many of people become a part of that fraud because they encourage the people to invest money in that company. So I think a fake promise is also a part of fraud.
Definitely, yeah. So if you're going to investors, you're collecting money from the public, you're kind of saying that you're this successful company, then there's this expectation that you will continue to perform and you'll use the funds invested in your company with ethics and with the utmost care. But it sounds like this company kind of just took the money and ran away. So that's definitely an example of a very severe example of fraud. So yeah, that's exactly right. Thank you. And then Sonia, I think you were last, but you put your hand down.
Yes,
Anything to
ma'am.
add?
The Harkamal said I was exactly said to say to that. Like
Oh, you want to
someone,
give the same example?
yes, ma'am. I'm also thinking about that. Some people just offer and make some kind of commitment by their words or by some kind of notes, and laterally they just deny to complete their commitments, and they
Yeah.
run away with the money. That's all fraud.
And part of that is we have like investors, the people that invest into companies have to be very careful as well. There's a lot of companies that will come in and they'll market themselves and they'll say all these smooth things, but you have to kind of go through as a manager, as a business owner or a business manager, you have to be able to see who's worth your time and who you can trust and who is a bit of a charlatan and might potentially, you might get into a contract with them, then they're supposed to provide you with some services for some fees, and then they just kind of take your money and they disappear. So it's also good to be kind of cognizant of who you're doing business with and who you're transacting with when you're making those decisions as well. So good, yeah. So everybody has a good kind of fundamental understanding of what the definition of fraud is. So it's some kind of deceit. It's some kind of intentional act where you're kind of it's to your benefit and somebody else's demise. Some examples of fraud we talked about. So there's Ponzi schemes, there's tax evasion, there's just dishonesty where you basically just collect money and then run away. And how does fraud happen? Fraud happens when there is an environment. Some people will just, no matter the environment, they will take steps to perpetuate fraud, or they'll take steps to be fraudulent or disingenuous. But in certain environments, we can kind of make it so that fraud is less likely to happen or has less ability to happen. So we come and we see our fraud triangle. So here we have 3 points. So there's opportunity, motives or pressures, and rationalization. So starting at the top, it has to come from an opportunity. There has to be a lack of or end of internal controls, and senior management is not watching. So if you have an environment in your business where I keep making this example of a diamond warehouse. So let's say you are making you manufacture diamond rings, you have this big warehouse, and everybody can come and go as they please. If you don't have locks on the doors, if you don't have kind of key cards that identify who's coming and going, if you don't have cameras within your warehouse, then there's a high likelihood that one of these diamond rings ends up in a pocket of one of your employees or a total stranger, and it walks out the door. So you're creating the opportunity for fraud to happen by not having good internal controls. And yeah, and people follow whatever the tone at the top is. So whatever tone your senior management has is what is followed within your company. So if senior management is very nonchalant and doesn't really follow the rules themselves, then your employees or other people are going to think, well, they don't really care. Why should I? And why they're benefiting, I can too. They're corrupt, so I'll be corrupt too. So it's really setting the tone at the top as well to reduce the opportunity for fraud to happen. Next up, we have motives and pressures. So this is within your company. This is within your control. Next up is motives and pressures. So this is kind of out of your control and it depends on the individual. So they might have personal financial pressures. They might have an addiction. They might have, I don't know, they might have gotten a parking ticket for $150 and they don't have the cash and they really need to pay the parking ticket. Otherwise, it'll kind of snowball. So the motives and pressures are personal and within the individual. And some people are just crooks. Like there might not be a motive or pressure that you can put your finger on. And then lastly is rationalization. So rationalization is the person that is doing the dishonest act. How do they rationalize it within their own brain? They say, well, I haven't taken a vacation for 3 years and the company doesn't appreciate me. So I'm going to take the pen. I'm going to take $1,000. I'm going to take a piece of equipment home with me. And that's how they rationalize their actions to get rid of that cognitive dissonance inside their own head. Or, oh, it's only a loan. I only need $500 for like 2 weeks and then I'll get my paycheck and then I'll pay it back. So then it's kind of rationalizing their actions and saying, I know I'm doing something wrong, but this is why I'm doing it, and that's okay. So that's what rationalization is. And then these 3 points make up the fraud triangle that you see here. So fraud is an issue, but again, the more and more you take away the opportunities for it and the more kind of controls you put in place, the less likely, even if the motives are high and the rationalization is high, because they don't have the opportunity to, it becomes more and more difficult for fraud to actually take place. So the only thing that companies really control is the opportunity portion. And then the motives and pressures, well, you can kind of look to hire people or bring people on that don't have this kind of background, and so it becomes a little bit less of an issue. And rationalization, you can't really control this unless they have a way of communicating to you what's going on in their head. You don't really know how this rationalization process happens. Well, how to mitigate fraud? So there were these, like the company you guys were mentioning in India that kind of took the money of all the investors and ran away laughing. We had a similar version of it in the United States called Enron and WorldCom. If you've gone through a business degree, I'm sure their names have come up. If you've never heard of these two companies, I highly recommend that you do a little bit of research. There's a bunch of YouTube videos on it. There's a bunch of movies on it that explain what happened. And it really shook up the business world. And now, to mitigate another Enron or WorldCom from happening and to mitigate fraud, there's the Sarbanes-Oxley Act. So again, what Enron did is they collected a bunch of investor funds, and then they spent it very irresponsibly. They siphoned it away. They started telling their accountant to change the books and put in different numbers than what should have been there. They all started to kind of get a little fancier, get nicer cars, get like laser eye surgery, start to look a little, get better suits, and then it all came tumbling down. A lot of investors lost a lot of money. The stock market crashed for a little bit, and there wasn't any sort of laws or regulations to be able to litigate and pursue them to the full extent. So then in response to that, we now have these regulations that came about. So the first is an internal control report. So if you're a public company, if you trade on an exchange and you can issue shares to the general public, then you must issue an internal controls report. So you have to detail what internal controls your company has, and an independent auditor has to come and evaluate your firm's internal controls and make sure that they're operating correctly. So it's one thing to say that you have internal controls. It's one thing to say that there is a lock on the door of your warehouse, but it's another for someone to come and test and see if it actually locks, who has the key, and how well that control is actually working. So that's what the internal control report requirements are for. Next up, there's the Public Company Accounting Oversight Board, also known as PCAOB. This is in the United States. In Canada, we have CPAOB, so we have a Canadian version of the Public Company Accounting Oversight Board. This is an independent board that oversees the work of auditors of public companies. So I work with public companies. So my job is financial statements come in the door, I review them, and I tell the public company, this is okay, you can post it. And then above me, there's another kind of board that comes and looks at me and says, how did you do your job? What did you check? What did you look at? Did you do your auditing job properly? So they audit the auditors. So there's the oversight board, there's the auditors, and then there's the financial, there's the public companies and their financial statements. So this didn't exist. This oversight board didn't exist until Enron happened. And then now there's also a separation of consultant and accounting auditing functions. So if an auditing firm is performing an audit for you, they're not allowed to provide consulting functions for you. So for example, if PwC comes and does your audit, they're not allowed to provide you with tax planning or valuation services or any sort of day-to-day accounting or calculations. You have to go to another firm for them to provide you with those services, or you need another team that's independent from the team that did your audit to do that work for you. So they've segregated the consulting and auditing functions to make sure that there is independence. And then lastly, they're saying that there's really stiff, they're not saying, there are very stiff penalties for violators. So now there's 25 years of imprisonment for securities fraud and 20 years for executives making false sworn statements. So if you are caught being deceitful, making false statements, or having securities fraud, so using insider information for your own benefit, then there is heavy penalties for doing so. Now, as a CFO and a CEO of a company, you're now required to sign off. So every time your financial statements are posted, you physically have to go through and sign off and say, I confirm that there is no, this is the best I could do. This is the best information that I have available to me. But if there's, let's say if like Behzad's company, there's someone inside, there's an accountant inside your company that's being fraudulent, you can't know that. So it doesn't make sense for you to get in trouble for something that you didn't know. So if someone within your company is fraudulent, the executive isn't going to go to jail for 20 years. But then you have to disclose it. You have to go through a process and quantify how much there was misstatements, and you have to kind of go through the process of explaining what happened. But you're expected to act genuinely and act true to all the information and disclose all the information that you know to your auditors. So that's why there's this required sign off now. And this has become very serious. This was taken lightly before, and we were operating on the basis that everybody was acting ethically and responsibly, and more it comes out that corporations are not. So the penalties get stiffer, the regulations get higher, the requirement for reporting increases over time as a response to people messing up in the past. that's fraud. Next up, we're going to talk a little bit more in detail about internal controls. So the internal controls are processes that you put in place within your company to stop bad things from happening. And it consists of these components. So there's your control environment, your risk assessment, your control procedures, your monitoring controls, and your information systems. It's in a circle because it goes round and round. You don't just do this once and then tuck it away. You do this, but then you have to continue to monitor, improve, and analyze and assess how well this is working. So at the very top, you have your control environment. Again, this is the tone at the top. This is how much management cares about controls, how much people want to do the right thing, and how much people want to ensure that other people are held accountable for their actions. So that's your overall control environment. And then from there, you're doing your risk assessment. And this is company specific. So you're doing an assessment of where there is high risk and where there is low risk. If your inventory is diamonds, your inventory is of a high risk. If your inventory is, I don't know, if you work at a dollar store, then all your inventory is worth $1. So your risk of inventory is still there, but it's a lot lower, because if you lose 50 pieces of inventory, it's $50. But if you lose 50 diamond rings, that's closer to $50,000. So it's really on a case-by-case basis. So if you know that your inventory is of high risk, then you have to take steps to control it. So you have to make sure that you have a lock on the warehouse. Maybe you have a camera set up. Maybe if you're a retail store and you have really expensive handbags, maybe you put a security guard at the front door. Another example is a pharmaceutical company. So if you have a lot of raw materials and raw drugs that are going into your final pharmaceutical product that comes out, well, you want to make sure that those drugs are kept away, they're kept in a cupboard somewhere that gets locked, it's under watch, you don't give everybody the access to the keys, you have security in the facilities that do walkarounds. Or if you're working in an electronics store, maybe you're looking through your employees' handbags or their pockets before they leave your store at the end of the day, just to make sure that they're not pocketing or taking anything with them. And cash. I think no matter what your company is, cash will always be a risk area, because it's very easy for me to put cash in my pocket and walk out of the company, and then I just have money. I don't have to go through the process of selling anything. I don't have to find a market to sell my illegal drugs on or my diamond ring on. I walked out with cash in my pocket, and that cash is easy for me to spend anywhere, and it's untraceable. You can't come back to me in 3 years and say you took $10 out of the cash register unless you have proof. So the proof comes from, again, having a camera, having a locked cash system, having your checks kind of stowed away. So you're doing that risk assessment and determining what risks your company has. And then once you've analyzed and identified your risks, you can go through and make control procedures. So all the items I was talking about, like the video camera, like the locks, like the like keeping people outside of certain areas, bringing in a security guard, those are all control procedures. Those are all items that you can do to make sure that people are taking the right steps and following the rules. A really easy one to think about, and something that happens frequently in a lot of companies, is a timesheet. So one of the control positions, I don't know if these exist anymore in the world, but back in the day, what we learned was a control procedure is having people punch in. So there's a clock on the wall, you have a little card with your name on it, you walk in, it stamps the time that you came in at, and then again when you leave, it stamps the time that you left at. So then that makes sure that if you're being paid for 8 hours of time, you were physically there for 8 hours of time. And that's just a control procedure to make sure that you're not being paid additional amounts when you're not actually working or providing services to the company. So the next step is to monitor the controls. So once you've set up the controls, you actually have to go through, if you're paying a security guard to stand there, is he actually standing there? Is he actually acting tough? If you've put in all these cameras, do they work? Can I go back and look at the video? Does it exist? If I have keys for the warehouse door. Is it being locked? Is it being used? If I have people logging into a certain cash system, are they logging in and logging out? Or is Sue logged in forever on that cash system and I don't really know who's using it? So you have to go through and have your internal controls monitored. And then lastly, there's your information system. So that's how, so you're checking your information systems and making sure you have controls there as well. So your information system, you're making sure, seeing who has access to the accounting records. How are they going through and making their journal entries? Is there anything fraudulent happening in your information systems? Has anything been deleted? Is there 2 hours of your video surveillance that magically doesn't exist anymore? So it's going through and making sure that your information systems are also working. And then again, these things change, so the circle goes around and around. So those are your internal control components. And then 6 principles of internal control activities. So these are the most important activities that are included within having good internal controls. And that includes establishing of responsibilities. So who does what? Who collects the cash? Who handles the cash? Who takes the cash to the bank? Who puts it into the accounting records? Who reviews the accounting records? What are those processes? And then segregation of duties. So you don't want the same person that has access to the cash to have access to the accounting records, because then they can take the cash and change the accounting records. So you want to make sure that there is the ability to segregate who handles the cash, who handles the accounting, who handles the bank runs, who handles cash collection. So you want to be able to separate all of those different roles. You want physical controls. Again, this is the lock on the door. This is the key pass to get in. This is passwords that you have on computers or individual login IDs. Documentation procedure. So you want there to be a handbook that you give employees when they come to join your company. You want there to be rules and regulations that are communicated to each of your employees so that they know how they should behave. Oh, this is not, sorry, it says 6 and then there's 7 because physical controls is done twice. Sorry about that. Let's get that back up. I was a little asleep when I was making these, but now I'm more awake. So physical controls, we only need it once. Documentation procedures we talked about. Independent internal verification. So again, this is checking that all the controls, all the physical controls that you've put in place are working. And then last is human resource control. Again, some people are crooked and they will, that's inherent to their personality and you don't want them working for you. So having human resources, having a more keen eye when you're going through and hiring people really helps mitigate a lot of these issues and can help reduce the amount of problems that you have in the future. So does the person that you're coming in have a criminal background? Should they be handling money? Do they have a history of addiction? Were they fired from their last 15 jobs and you don't really know why? So it's important to look at the background of people that you're hiring and bringing into your company as well. That is, sorry, I'll go back. That is internal controls. So this was our fraud and internal controls discussion. So that was our 3rd learning objective. We're going to roll into a quiz and a break. I will post the quiz within Teams, and I've heard complaints that I don't give enough time for quizzes. So I was going to give you 15 minutes, but I'll give you 20 minutes instead. So it's 7:44 right now in Vancouver. So I'll give you 20 minutes. So we'll come back at 8:05. I will go through and post this really quickly. Let's go back to Teams. And if you have any issues, I know there's been issues in the past trying to get to the assignment, especially if you don't have your Gus Canada email. So if that's the case, let me know and I will go through and give you a different link. Sorry.
Should we have to try to attempt the exam? The quiz?
The quiz, yes. And I will post it in the chat as well, so it's easy for you to find. And you have until 8:05. Oh, sorry, Bestad, you said please slow down. I will. Sorry, next time if you want me to slow down, just raise your hand and tell me. I'm sorry, I don't see the chat when I'm chatting or when I'm presenting. So please just tell me to slow down. You feel free to unmute yourself, and then we're good to go. But I'm happy to repeat. Once we come back from the quiz, I will take your questions about anything we talked about, and then we'll go through the quiz together. So for now, it's 7:45. You have until 8:05 for the quiz. And if you finish earlier, then take a stretch, take a break, take a breath, and we will reconvene and go through the answers. I will see you soon. And again, if you can't open the quiz, let me know, and I will take steps to get you a link that works. And we're back. How was that one? How did that quiz go? Good, bad, ugly? We have some ratio analysis review to do, maybe?
Yes.
Maybe. Okay. Adopt. Okay, so share screen, first and last name, easy enough. Current assets. So current assets are listed by order of expected conversion to cash, by importance, by longevity, or alphabetically. So current assets are listed by the order they are expected to convert to cash. So you start with cash and then you have, so this is where I was going to show you. So let's take a, we're going to go back to CDAR as well. Oh, CDAR down. CDAR's down. Okay, I'm not going to go to CDAR. I'm going to show you, oh, how do I show you financial statements now? Let's go look at Microsoft. We'll go to, yes, so I'll show you Edgar. So Edgar is the American version of CDAR. So Edgar is under the US Securities Commission. It looks a little bit more polished than our Canadian version, if I do say so, but we can take a look at Microsoft. So Microsoft Corporation, we'll go take a look at their, sorry, I'm used to the classic view, so I'm going to switch to classic view and I'm going to go take a look at their quarterly report. So you go documents and then you can go under Microsoft. And then once it loads, oh, someone's waiting in the lobby. Let me let them in. Sorry. Admit. So looking at Microsoft's financial statements, so we want to get to the balance sheet. So we can see in their assets, sorry, is this too wide? Is it better if I do this? Smaller, bigger, better, worse? Let's minimize stuff around here so it's not as ugly. Okay, so we can see that on Microsoft's balance sheet, their current assets are cash and cash equivalents, short-term investments, accounts receivable, inventories, and other current assets to give you total current assets. So the way that these are listed is in order of expected conversion to cash. So cash is cash, there's no expected conversion, and cash equivalents are close enough to cash that they will be converted to cash quickly. Next up, we have short-term investments. So short-term investments are anything like a GIC or a treasury bill, which you expect to quickly convert to cash. Accounts receivable is when you make a sale or a service, but on credit. So Lynette provides me with services, and then I promised her to pay her $100,000 in 1 month's time. So she would record accounts receivable of $100,000 and revenue of $100,000 on the day that we trade services. So accounts receivable, and then a month will go by, and that accounts receivable, I come back to Lynette and say, thank you for your services. Here's $100,000. So that's how that one would work. Oh, I don't know why this. Yes.
The edit page is behind another window that you have open.
What's behind? So you guys can't see these financial statements right now?
That is correct. Now we can see the screen with our images, and it is behind. It is.
It's okay now? Yes, no, maybe so.
Let me see. Not on my end, but it might be my internet. I just want to see. Okay. Okay, perfect. Yes, it works for me.
Better now? Okay. So then, so that was your accounts receivable. So that's when that is expected to convert to cash when your customers actually pay you for what you are owed. And then inventory is items that you hold that you plan on selling as revenue. And that is when you sell it, it goes into accounts receivable, and then from accounts receivable, it'll go to cash. So for that very first question, current assets are listed by order of expected conversion to cash. Question number 3, for 2020, COW Corporation reported net income of $26,000, net sales of $400,000, and weighted average shares outstanding of 4,000. There were preferred dividends of $2,000. What was the 2020 earnings per share? So we know that our earnings per share is equal to our net income minus our preferred dividend divided by the number of shares outstanding. So it's going to be 26,000 minus 2,000, giving us 24,000 on the top, on the numerator, dividing it by 4,000 shares on the denominator. And that's going to give us $6 per share. So that is number 2. Any questions on that one? We're all okay? Okay. And then we get to the question of Billy and Bob. So we are given a bunch of ratios for Billy and we're given a bunch of ratios for Bob. This question was worth 3 points. Just I wanted to signify that it was going to take you a bit longer and that it was okay to take the time to try and get it right. There was also 3 parts to the question. So it asked you about liquidity, about solvency, and profitability. So first, let's look at Billy. So Billy has a current ratio of 2 to 1, a debt to asset ratio of 75%, and earnings per share of $3.50. So their current ratio means how much current assets do they have to cover current liabilities. So for every $2 of current assets covers $1 of current liabilities. So that's a good level of liquidity. This is a good ratio to have. You have more current assets than current liabilities, so you're able to pay off all your liabilities and you still have some money left over. And then for your debt to asset ratio, you have 75% of your operations being funded by debt, and then 25% is going to be funded by equity. So 75% debt is a bit of a high debt load to have. So this diminishes your solvency. And then your earnings per share is $3.50. Again, earnings per share is the amount of net income you have on a per share basis. And then on the other side, we have Bob. So Bob has a current ratio of 1.5 to 1. So this is also a good ratio to have. Not as strong as Billy, but still pretty good. They have a debt to asset ratio of 40%. So they have 40% of their operations funded by debt. This is a better ratio and it's lower than the 75%. So this makes Bob more solvent than Billy is. And then earnings per share is $2.75. So this morning, there was a bit of confusion over, I'm going to open up an Excel document really quickly. There was a bit of confusion. Okay, so first, the answer. The answer is compared to Bob Inc., Billy's current ratio is better, so it has higher liquidity. So it can be this one, or this one. And then Billy has lower solvency. So it has 75% debt compared to 40% debt that Bob has. So it has lower solvency. So it can be either this one or this one. So we're between C and D. And then lastly, it talks about profitability. We can't determine profitability because we don't know the number of shares outstanding in Billy and the number of shares outstanding in Bob. So there isn't enough information for us to be able to compare profitability between Billy and Bob. So what I mean by this is going to require a little workbook. So we have Billy and we have Bob. So let me just zoom in. We have net income. We have our shares outstanding, OS, and then we have our earnings per share, which is EPS. So we were told that the EPS for Billy was, we have $3.50 and $2.75. So this is $3.50 and, and $2.75. And then let's say, for example, Billy has 10,000 shares outstanding and Bob has 2,000 shares outstanding. So then our net income, working backwards, would be 35,000 versus 5,500. So looking at this really quickly, we can see that even though, I'm going to switch this around just to prove a point. So even though on a per share basis, Billy looks like it has the higher earning per share, so it looks like it's more profitable. When you look at the net income amount, Bob has a higher net income than Billy does. It's the number of shares that changes the earnings per share and makes it look less profitable. So just based on the EPS number, without knowing the number of shares outstanding, we can't determine which company is more profitable. And having a different denominator means that we're not comparing apples to apples. So this ratio isn't, or this comparison isn't a good one. We shouldn't be comparing EPS between the two companies without knowing the number of shares that there are between them. Any questions on this one? It's a little bit strange, I know.
Yes, ma'am. I need to confirm one thing.
Sure.
In the future, when we are going to compare EPS, is this going to be constant that if the information is not fully given to us about the number of shares outstanding, we are going to say that it is not determinable because the denominators are not same?
Exactly. Yep. Yep. That's a fair assumption to make.
Okay, thank you, ma'am.
Of course. Any other questions about the process? About how we got to the higher solvency, or higher liquidity, lower solvency? Does the way that we're doing the comparison make sense?
Yes.
Yes?
Yeah.
Okay, so then so that was question number 4. And then question number 5, companies can use free cash flows to pay additional dividends, acquire more property, plant, and equipment, or pay off debts, or all of the above. So free cash flows can be used for any of these items. So you can decide to pay additional dividends to keep your shareholders happy. You can acquire more property, plant, and equipment to help make more efficient use of your operations, or you could use it to pay off debt so that you can increase your solvency or look better to investors in the future. So that one was all of the above. There are only 4 ratios used to perform ratio analysis, is question number 6, and that's false. I only introduced you to 4 different types of ratios or calculations just to begin because I didn't want to overwhelm you. There's a million different analyses that you can do. You can calculate earnings to profit. You can calculate like book value to fair value. There's an entire course in finance that you can take on ratio analysis. So I'm just introducing you to these 4 just to begin with, just to get you into a little bit of financial statement analysis. Question number 7, holding all other factors constant, indicate which of the following signals generally good news about a company. So a decrease in earnings per share. A decrease per earnings per share, again, our formula is going to be net income divided by the number of shares outstanding. So a decrease, so maybe it was better if I draw these out. So the first part was, let me zoom in on this guy. First one is earnings per share. Earnings per share is net income on the numerator, and the denominator is share capital, or number of shares. Number of shares. So if my EPS, if my overall EPS is going down, that means that either my net income is going down, which isn't a good sign, or the number of shares outstanding is increasing, which means that I'm diluting my shareholdings. So that's also not a good sign. So we know that A is incorrect. B says increase in current ratio. So our current ratio, I'm just going to go CR, is your current assets over your current liabilities. For this ratio to increase, so for your current ratio to go up, you either need your current assets to increase or you need your current liabilities to decrease. So in this case, it is good news. If your current assets are going up, it's great because it means that you have more cash, more accounts receivable, more inventory, more current assets on the books. And if your current liabilities is going down, that's also good because it means you have the ability to pay your obligations and your obligations are decreasing. So having your current ratio go up is good news. But just going through the other ones, let's look at the debt to asset one, make sure that we're right. So debt to asset, I'm going to go DTA, is your debt divided by your asset. So if there's an increase in your debt to asset ratio, either your debt is going up or your assets are going down. Neither of those are good news. If your debt is going up, it means you can't generate enough money internally and you had to go to market to get more debt. And if your asset base is decreasing, then that also means that you're utilizing your assets and you're diminishing the number of assets that your company has, which could be a sign of trouble as well. So this one is incorrect. And a decrease in free cash flows means, again, you have less money to pay out to your investors as dividends, less money to reinvest in your company, and less money to or less money to pay off debts. So if your free cash flows are decreasing, that's also not the greatest sign for your company. So the answer is B. Increase in current ratio is the only one that shows that there's general good news about the company. So that was number 7. Number 8, stockholder equity is divided into 2 parts, common stock and retained earnings. So this is true. We were talking about this at the beginning of the class. So equity has a portion of it going to your common stock, which is the portion of your company that you're giving away, and then your retained earnings, which is the accumulation of your profits. So this one's true. Last one, I just throw a bunch of numbers at you, hoping that you would figure out which ones that you had to use and do the appropriate ratio analysis. So it's asking you what the debt to asset ratio is. The only numbers that you needed was your total liabilities of 42,000 and your total assets of 120,000. If you take 42,000 divided by 120,000, you get 35%, which is what your debt to asset ratio is. You had enough information to calculate your current ratio, which would have been your current assets and current liabilities, and you had enough information to do your EPS, which is your earnings per share, which would have been net income divided by the average shares outstanding, but I was only asking you about debt to asset, and that's 35. So that was the quiz. Again, the quizzes are just for participation, nothing else. So as long as you submitted your answer, you're good to go. You have nothing to worry about. And then any questions? So any questions on what we talked about at the beginning of class in the PowerPoint, or any questions about the quiz that we just went through? Everyone okay? You guys are smarties. You guys have no questions. You're like good to go. You're powering out, or you're just really sleepy and you just want me to shut up, and that's okay.
Hi, Professor. Do we have any notes for these ratios?
Yes, so the notes are here. So once we go back to Moodle, sorry, that's the syllabus. We are section 13. So if you go in week 1, right here, you will see class 2 items. If you click on this guy, you have unit 2 notes. So this unit 2 is the ratio analysis notes.
Sure. Thank you.
So there you have the definition of the 3 types of ratios that exist, and then the types of analysis that you're doing. This is incorrect. It should say annual comparison, not enable editing. This should say annual comparison, not intercompany comparison. And then you have your earnings per share, your current ratio, debt to asset ratio, and free cash flows. And these are the questions that they answer. So it's a really quick set of notes just to give you a bit of an overview. Yeah, they do exist under week 1.
Thank you.
Of course. Any other questions before we move on? I know one of the questions is how can you see the quizzes again? I am working on it. I think Teams does have the capability of me giving it back to you. If it doesn't, I will post it on Moodle and you will have access to the quiz and the answers there. Okay, we're going to keep motoring along. We have another half an hour to go and 2 more learning objectives to cover. So let's get the ball rolling. So we are on, where are my learning objectives are gone. Okay, my learning objective number 4, sorry. So we covered off, so 1 and 2, you're going to cover off on your own again. These are in the notes that have been uploaded during week 2. We talked about fraud and the concept of internal controls. So now we're moving on to how a bank account is a control feature. So we're going to be covering off this and then, pardon me, quickly going over a bank reconciliation. So the bank account as a control device. So a bank account is a really I'm going to backtrack. We all know that in a company, cash is king. So the amount of cash that you have is one of the biggest metrics of how long you can operate for. So if you're burning through your cash too quickly and you're not bringing new cash in the door, then your business is going to be in a lot of trouble. So every good manager and everybody at the top of your organization will be concerned with how much cash you have on hand and how much of it is you're burning through. So this is why we put such an emphasis on cash. So again, everyone knows what a bank statement is. It's a piece of paper that you get from the bank every month. It tells you how much money came into your bank account and how much money left your bank account. So you've gotten them as individuals, and a corporation one is very similar. It's just it just summarizes the transaction that the company had instead of you as an individual. So It's a good control device because it's external. So it's prepared externally, not by your internal accounting company. So it's very good in that way where you can see from an independent third-party standpoint what's happening with your cash, what's coming in, what's going out. And then from there, banks also have a lot of controls. So if you're giving a deposit to the bank, they want a deposit slip. If somebody wants to get money out of your account, they either have to sign a piece of paper or they have to come with a check signed by you saying that you're allowed to take money out of the account. So you can utilize some of the controls that the banks have in place to make sure that your cash is handled well. But internally within your company, you also have to go through and take some steps. So these titles that establish responsibility, segregation of duty, documentation, so all these titles tie to the items that we discussed. So these 6 principles right here tie to these 6 principles that we have for our cash purposes. So the first step is to establish responsibility. So you're going to choose a designated personnel, a trustworthy person who is going to be authorized to sign checks and approve vendors. So they're going to be the one that is going to be in a position where they're going to be signing the check. They're going to look at the invoice, look at the check, agree the two together, make sure that it is from an approved vendor and that you are okay to pay them their invoice and sign off on the check and give it back to whoever it goes to. So this is either the treasurer or a controller or your accounting manager, somebody in a higher position who's also keeping track of when the payments come due. So that's why she has a calendar behind her with all the dates of the payments coming due. So that is your first step, is establishing a person to have that role. Next up, you want to make sure that you're segregating duties. You want to make sure that different individuals are approving and different individuals approve and make payments, and the check signers do not record the disbursements. So whoever is handling the cash doesn't handle the books and vice versa. So if this person is in charge of signing the books, there must be somebody else that is in charge of entering the transactions into the accounting system. So that's what they mean by segregation of duties. Thirdly, you want to have documentation processes. So one of your procedures can be that you're using pre-numbered checks. So whenever you go to a bank and you get these things called checks, they will have sequential numbering on them. So you'll have check 58, 59, 60, 61, all the way through. And each check must have an approved invoice. So you want to make sure that when you're going through the process of approving checks within your organization, you want to make sure that an invoice and a check come together and stay together. Otherwise, there's a likelihood that you will have 2 check payments going out for the same invoice, or somebody changing a line item on that check that you've signed off on. So you want to make sure that these the documents are pre-numbered and that the check and the invoice stay together. And when it's paid, the invoice gets a paid stamp. So again, you're not double paying any item. You want to require employees to use corporate credit cards for reimbursable expenses, and you want to communicate rules to them over what the reimbursable expenses are. Next up, you want to make sure that there's physical controls. You want to store blank checks in safes with limited access and print checks amounts by machine in indelible ink. So this is something new that some companies do, is where they won't write on a check anymore. They'll have it go through a computer. So having that happen makes sure that that there's no issues with a check being signed and then the name or some sort of tampering with the check and change before it goes to the bank. And then again, you want to make sure that you're not just leaving checks in the lunchroom, you're not leaving it somewhere unattended or in an unlocked drawer. You want it to be somewhere safe and with limited access. Next, you want to make sure that there's independent internal verifications. So this is when you're comparing your checks to the invoices. So you want to make sure that the amount on the invoice is the same as the amount on the check. So when there's a receipt that comes in saying I owe, I don't know, Home Depot $10,000, then I want to make sure that my check to Home Depot is also for $10,000 and not for $1,000 or $100,000 by skipping or adding an extra zero. And then your other independent internal verification is by reconciling bank statements monthly. So you have the bank's records and then you have the company's records, and you want to go through and make sure that these two align and match. And then lastly, human resource control. You want to make sure that bonded personnel, so good quality personnel, handle cash. You want to require employees to take a vacation, A, for them to be rested and not making mistakes, and B, so they don't feel an incentive to get back at you for something or to take additional funds away from you. And lastly, you want to conduct background checks and make sure you're not bringing criminals into your organization. So that's the process. So this is a further example of how internal controls are the steps between internal controls. But again, if this person quits, then you have to bring a new person in, you have to communicate their role to them, you have to tell them who the approved vendors are, you have to make sure that they get authorization to sign off on checks, and then you kind of start the whole process again. So it's not just a one and done, it's a cycle, and you kind of keep having to go through it. Documents in the cash control cycle. So you have checks we talked about. So checks are how you get money from your company to a vendor. So checks are written from the company, signed by a representative of the company, like the treasurer in the past slide, and then handed to a vendor. So if let's say Behzad is providing us with raw materials that we make into our inventory, then I would write him a check and say, this is for the raw materials, written it out to Behzad's company for $2,000. He takes that check, takes it to the bank then gives him $2,000 cash out of my company's bank account and takes the check away from him. So that's the process of checks. A deposit book is the opposite way. So whenever you have money coming into the bank, let's say, for example, Sonia invests in my company and gives my company $50,000, then I would write, Sonia gave me $50,000 on July 20th, 2021. So that's where I record all the deposits. I collect the cash from Sonia, and then I would take the cash to the bank and deposit it into the company's bank account. And then the deposit book is where I keep information about that. Bank statements are, we all know what bank statements are. You get it at the end of every month. It shows all the money coming into your account and out of your account based on the bank's records. And then we have bank reconciliations. So bank reconciliations are what the company does at the end of the day to match the company's records with the bank's records. So we're going through and we're comparing and seeing what differences exist between the bank statement and the bank reconciliation, and then just making the two, we do a reconciliation to make the two match. So, are you all still with me? Sorry, I lost my visual of you guys. Okay, everyone's still here, everyone's still nodding along, no chat messages, no hands up, so we're all still okay, I hope. And if we're not, let me know. So we have, so this diagram takes you through the different people who are involved. So we have a clerk, we have a cashier, we have the supervisor, we have the accounting department, and then we have the bank. So just kind of taking you through, a clerk works day to day, they enter sales and they count cash, and they put the cash in the cash register. At the end of their shift, they would take out the cash and they take out a count. So they'd count the cash, and then with a piece of paper counting the cash, saying what the final amount of cash was. They collect both of those from the cash register, and then they'll take it down to the cashier. The cashier counts all the cash from all the different cash registers and prepares a deposit slip. The deposit slip has two pieces. One piece goes directly to accounting and says, okay, today we had $9,000 of deposits, so it would have the date and the amount, and then another piece of the deposit slip and the money go together to the bank. So the bank would receive a deposit slip saying $9,000 and receive $9,000 in cash. If there is a discrepancy in here, the bank would be contacting you. So this is what goes to the bank, and this deposit slip goes to the accounting department. And then on the other side, we have a supervisor. So the manager at the end of the day comes and removes the locked register's cash tape. So they deal with the records. Sorry, letting someone in. They deal with, so the clerk just dealt with the cash, but she doesn't have access to the information system, or she doesn't have access to the register that is within the cash register. So there's a list of transactions within the cash register that the supervisor comes and takes out and transfers to the accounting department as well. And in a more sophisticated company, this would happen automatically, where your point of sales system automatically connects to your accounting department. So then the accounting department will go through and they'll agree the register tape. So they'll agree the records from the point of sale system to the amount of cash that was received through that deposit slip. And they'll record the transaction. If there's any discrepancies, then we'll know who to go to. We'll either go to the cashier who had the cash and the deposit slip, or we'll go to the clerk and ask them why there's a discrepancy between what was in the records and what was in the amount of cash that was provided. And then we'll reconcile those differences internally. And then at the end of the month, we have our accounting department, which will have all the records from the point of sales, from the sales system. And then we'll have the bank, which will have all the cash that they would have recorded in their system from the deposits. So then we go through and we do our reconciliation. So this shows the steps that different employees are taking and how we're getting to the accounting records and the bank records. And then this is showing us how we're reconciling our cash. So starting at the top, we'll have two bank balances. We'll have one cash balance that comes from the bank statement, and we'll have a cash balance that's internally made from our books. The bank balance from the cash balance from the bank statement won't have the deposits in transit. So sometimes it takes some time from when the company collects cash to when the company when the cash ends up at the bank's records and facilities. So any deposits in transit will be added to our bank statement because they don't appear on our bank statement yet. So we would add this to our cash balance for the bank statement, and then we would subtract any checks that we've written that haven't gone to the bank. So during the month, you might write 15 checks, but people might not actually take those checks to the bank to get it cashed. So if that process hasn't happened yet, there will be some outstanding checks. So it's money that will come out of your bank account eventually, but hasn't yet. So that's why we subtract these amounts. And then if sometimes the bank makes an oopsies, they've gotten a lot better at not making oopsies, but if they do make an oopsies, then we are adding or subtracting those bank oopsies to get to our ending correct cash balance. So this is one reconciliation we do, starting from the bank statement, and then there's also another reconciliation that we do based on our books. So we go to our accounting records, and we take a look and see how much our cash balance is. We then make adjustments to the books for electronic fund transfers and collections and other deposits. So sometimes there's automatic deposits that go into our bank account that we haven't recorded in our books. So we have to go through and add those items. And then sometimes, unfortunately, there's not enough money in the company's bank account, so there's non-sufficient funds. So non-sufficient fund checks are subtracted from our book balance because they haven't gone out yet, but will. And sometimes there's also other charges and payments that are incurred for non-sufficient checks that bounce. So we would be taking away any of the other amounts that the bank charges us. So for example, if you are a company in Vancouver and you bank with BMO, they charge you about $35 to keep your account open with them for all the services they provide you. So we would have to subtract $35 from our book balance because we haven't gone through and reported that expense yet. And then we're all human. Sometimes the company makes an oopsies and there's a mistake in the accounting department, so we would be adding and subtracting those errors as well. And then at the end of the day, praying to the accounting gods, we hope that our reconciliation for the bank balance and the book balance all equal the same ending correct cash balance. So if we take a look at this, oh, where'd it go? Okay, sorry, this should be a little lower. So again, this is the same information, but in table format. So that was a picture. Some people don't like pictures, some people prefer formulas. So this is kind of looking at it from a formula perspective. So you start with a bank, you have your end of month bank balance, you're adding deposits in transit, subtracting outstanding checks, and adding and subtracting errors to get to your ending balance. And then on the books, you're starting with your book balance, you're adding bank collections, adding electronic fund transfer receipts and subtracting the payments, subtracting bank service charges, adding interest revenue, subtracting non-sufficient fund checks and charges, subtracting any check printing costs that were incurred, and then adding or subtracting book errors. And then that way you're also getting to your ending cash balance. So we're gonna quickly look at an example. So this is a sample. We'll go through and do this. We'll physically go through an example where we do this process. But right now I just wanted to give you an idea of what it looks like in a live example. So we're starting with Laird Company. They're doing a bank reconciliation for April 30th, 2017. So first we start with our bank statement balance. So we're given our bank statement is sitting at $15,000 of cash, and we're gonna add our deposits in transit. So this is cash that we've collected, we've sent it, and it's on its way to the bank, but it hasn't made it there, hasn't made it into our bank statement yet. So there's an extra $2,000 there. So we have $18,000 of cash, adding those two together. Then we're going to subtract our outstanding checks. So there's 3 checks outstanding. We've written these checks, and they're going to come out of our bank balance, but they haven't found their way to the bank yet either. So the total of these 3 items is $5,000 that we're subtracting out. We get our adjusted cash balance per bank of $12,204.85. So at April 30th, that's our correct bank balance. And then we want to make a check. We want to see that our books are correct. So this time we're starting at the bank balance per our books of $11,709. We're adding in some electronic fund transfers and an error in recording check number 443. So we're adding in a little bit, $1,000 and change. So that gives us $12,780.45. And then we're subtracting out one unfortunate non-sufficient funds check, some debit and credit card fees of $120, and our bank service charges of $30. So we're subtracting out a total of $275 in a non-sufficient funds check and some fees. So that brings our total again to $12,204.85. So because these two numbers match, we know we've done a good job, the accounting gods are happy, and we can move on. And this is our adjusted bank balance at the end of the month. And this number is what would end up on our balance sheet. So again, I know it's a lot of information. Maybe just kind of take a look at this and let it settle in. And then on Thursday, we'll go through and do this example together. Not this example, we'll do a similar bank reconciliation together, but as a live example. So you'll work through each one of these numbers and it won't just be me talking to you. So that is, those are all our learning objectives today. Again, 1 and 2 you're responsible for on your own, and I will be quizzing you on this next class, so it would be wise to go through the unit notes on your own before Thursday. We talked about fraud and internal controls. We talked about how the bank account is a control feature, and we talked about a little bit about the theory behind a bank reconciliation and cash receipts and disbursements controls. So, and then in next class, we will be going through, we're going to run through a live bank reconciliation example. We're also going to run through how individual transactions are recorded in the books, and I'm going to introduce you to the concept of double entry bookkeeping. So we're going to see how that works. It's best through an example. I'm not going to make you watch me do it. It's best if we work through it together. Again, there will be a quiz on Chapter 3 material, so see notes on myucwest.ca, and I'll have some extra time for general questions. So if there's anything so far that has come up or anything that you want clarification on, I'll try and leave 5 or 10 minutes in class for us to go through those together as well. That is my entire PowerPoint for today. I now open the floor for questions for the next 5 minutes. If you don't have any questions, you're more than welcome to leave. Thank you for your time, thank you for your attention, and thank you for your participation in the quiz. But I am here if you have questions.
Hi, Professor. On the Moodle, I see there are some quizzes and exams like self-test. Are we supposed to take them?
Yeah, so those are just for your own. So I try to throw, you're talking about these guys, right?
Yeah.
I try to throw as many different resources at you as possible.
Okay.
There's also these resources as well where you can kind of go through and if you want more details, you can, this is really cool. You can kind of go through, it gives you some definitions. There's some videos for you to watch and some quizzes in here as well. So I try to throw as much different content at you as possible for however you like to learn. So I don't require any of those to be submitted to me. Whatever I do require to be submitted, I'll let you know in email and Moodle, during my presentations, during like you'll know exactly what you need to submit when you need to submit it. Everything else on Moodle is for you to kind of just play around with and see how you learn and what helps your understanding.
Sure, thank you.
Any other questions? But good question, yeah, because there is a lot of content on Moodle, I know. And some of my students are asking for more. So they're asking for more videos, they're asking for more notes. So I will be packing more into Moodle as well. But again, any resource that works for you, go ahead, use it, great. Anything that doesn't work, let me know. And I'll think about kind of removing it if it's confusing or if it's not useful. And I'll try to get more useful items in there. Thanks for the question, Pushpa. Thank you, Gaurav. It was nice. It's been nice chatting with you guys as well. Thanks for the nice comment in the chat. Any other questions? Any other issues? And we talked about peer tutoring. Can someone give me a thumbs up if we've talked about peer tutoring? We had someone present. Yes. Okay, perfect. So again, if any of these concepts seem really unfamiliar, if you're really scared, if you're really feeling anxious about this stuff, you have peer tutoring available to you. An hour is a long time. You can squeeze in so many accounting questions during an hour. So feel free to reach out to the resources that you have available. Any other questions? Again, I'm also available via email. I'm happy to hear from you. It can be an accounting question, it can be a CPA question, it can be a what do I do after my master's question. I'm still trying to figure it out, but we can figure it out for you together. So yeah, let me know if you have any questions or if there's anything I can help with. And office hours are on Friday as well. And I've gone through on Moodle and also put that in. So let's go back. Up here, you'll see under general information, you'll see when my office hours are, where the link is, and how to book it is you have to email me and let me know so that I actually show up. So that's how that works. If there are no other questions, I wish you a good evening, and I will see you on Thursday for some exciting bank reconciliations and double entry bookkeeping. Have a good night.
Thank you. Thank you so much.
Thank you.
Thank you.
Take care.
Thank you, guys.
Professor.
See you guys later.
Thank you, Professor.
Thank you as well. Devesh. I'm preparing for ACA, so I'm assuming ACA is the British/Indian version of the CPA. Would I suggest the CPA over it? If you have already started it, Devesh, I would recommend that you continue going down that path. The AACCA is recognized within Canada, and it's a really easy transition exam that you can do, I think, to get your CPA. So if you're going through the ACCA process, I would say continue with it. If you're moving to Canada and you want to do the CPA program, it is highly rigorous. It is very time crunched, but it's a worthwhile challenge. So I would say ultimately it's up to you, but I would say if you're comfortable with the ACCA, I would just continue with that. But I'm saying it based on my experience with the CPA program. If the ACCA program is also challenging and really difficult, then it's up to you to make that decision. But the CPA program will realistically take you 3 years. You have to get through 6 modules, and then you have to write a 3-day exam. So it is quite intensive. I would say if the ACCA is an easier process, maybe go through that process. You couldn't hear my last statement. Yeah, the choice is ultimately yours, but it's I'm guessing both are quite challenging.
Okay, ma'am. I already completed ACCA first level of 3 courses. I'm doing
Okay, then I would just say continue with it. Don't see that one through, and then do there's a transition exam that you can do to get your CPA letters recognized in Canada. So I would do that instead.
Okay, but ACCA is well recognized in Canada, right? I can use it for working, right?
Yes, you definitely can. Yeah, I've seen it pop up on LinkedIn, and we've had resumes slide across our desk with the ACCA, and it is recognized.
Okay, thank you.
Because it's recognized in the UK as well, is that correct? Like it very closely follows the UK.
Yes, it is a British standard, and it is
Yes.
head office in British. So
Yes.
almost many of Europeans and east of world are following this, like Malaysia, Singapore, and other East countries are following them. Only in US and Canada they are following CP.
Yeah, we're a little unique in this part of the world, but yeah, no, we definitely recognize the ACCA. If it follows the UK version, then it's easily transferable as well. So if you really want your CPA after obtaining your ACCA, it would be you do a transition exam. So from there, you would be able to get your CPA letters also behind your name in addition to the ACCA.
Okay, thank you.
Not a problem. Leonore, any questions? Any comments? I'm assuming everything's okay. I will end the class now. Thanks for sticking behind. And again, feel free to email me if you have any questions. Thank you. Have a good night or day, depending on where you are in the world.